Dear students, warm greetings on behalf of Dr. B.R. Ambedkar, Open University. Today's tele-lesson is all about the methods of financial statement. So, in today's tele-lesson, we will cover these topics. The first one, we will learn the introduction as to what a financial statement analysis is. Then we will learn the meaning of financial statement analysis. Then the definition of financial statement analysis. Then we will go about learning about the different objectives of financial statement analysis, the parties interested in financial statement analysis. Then we will conclude with the tools of financial statement analysis. So, this would be the presentation in today's tele-lesson. So, dear students, you might have already learnt the preparation of financial statements, that is how to prepare a balance sheet and a trading and a profit and loss account. So, after the preparation of the financial statements, one may be interested in analyzing the financial statements with the help of different tools, that is the comparative statement, the common size statement, ratio analysis, trend analysis, the funds flow statement and the cash flow statement. So, my dear students, once you have prepared the trading and profit and loss account and the balance sheet, it just gives you numbers. It doesn't help you in order to take decisions. So, in order to take decisions by all the users, it may be insiders like the management and the employees, or the outsiders like the creditors, investors, prospective investors, government. For anyone to take decisions, we have to analyze the financial statements. The numbers have to be analyzed. The numbers which is there in the profit and loss account and balance sheet, they have to be analyzed so that you get meanings to those numbers. Based on those meanings, we as users of accounting information can take different decisions, for which different tools such as a comparative statement, a common size statement, ratio analysis, trend analysis, funds flow statement and cash flow statement is prepared. So, in this lesson, my dear students, you will learn about analyzing the financial statements by using comparative statement, common size statement and trend analysis. So, dear students, financial statements are the end products of accounting process, as we have learnt. That is, after recording, classifying and summarizing, you prepare a balance sheet which tells us the financial position on a specified date. Also, you prepare a profit and loss account or an income statement which tells the financial performance for a specified period of time. So, financial statements are prepared and published by corporate undertakings for the benefit of various stakeholders. So, dear students, in simple terms, financial statement analysis entails reading a company's reports. That is, in the report, one will find out how much this company makes or loses, that is profits or losses. There are three accounts, dear students. One is income statement, balance sheet and cash flow statement. The income statement reflects profit or loss generated by the company over time. The balance sheet reflects what is owed and what is owned by the company. The cash flow statement shows how much money moves in and out of the company. So, people use these reports, that is the balance sheet, the profit and loss account and the cash flow statement, to understand if a company is doing well or not. Investors look at these reports before dealing to invest in a company. That is, business owners also use them to make smart decisions. We know business is mainly concerned with the financial activities. So, in order to ascertain the financial status of a business, every enterprise prepares certain statements known as financial statements. So, financial statements are mainly prepared, dear students, for the purpose of decision making. But the information as provided in the financial statement is not adequately helpful in drawing a meaningful conclusion. For example, I as a creditor, I as a supplier, I want to supply raw material to a company. I want to know what is a liquidity position. Will the company repay me? Because when I'm giving goods on credit as a supplier, it is a short-term credit. The company has to repay me within 3 months or less than that, not more than that, isn't it, dear students? So I as a supplier would like to know what is the short-term liquidity position of the company, for which I will look into the financial statement, the balance sheet and the profit and loss account, and I will calculate liquidity ratio, in simple terms the current ratio, current asset by current liability. If for every 1 rupee of current liability I have 2 rupees of current asset, it means my liquidity position is good. So I can give the company goods on credit. So the financial statement, dear students, the balance sheet and profit and loss account stand alone, doesn't help us in drawing any meaningful conclusion, doesn't tell us should I invest, should I not invest, should I make, should I buy, do I give credit, do I not give credit, do I invest in this particular company, do I not invest in this particular company. For any decision making purpose, how my company is performing, how my sales has increased over a period of 5 years, how did my cost of goods sold increase or decrease over a period of 10 years, how much is my gross profit for every 100 rupees of sales, how much of profit I am making, etc, etc, etc. All these information the financial statement is unable to give us. The financial statement is not adequately helpful in drawing a meaningful conclusion. So thus an effective analysis and interpretation of financial statements is required. So dear students, in simple terms, analysis means establishing a meaningful relationship between various items of the two financial statements with each other in such a way that a conclusion is drawn. That is, the term financial analysis is also known as analysis and interpretation of financial statements. It refers to the establishing meaningful relationship between various items of the two financial statements, that is the statement of profit and loss and a balance sheet. It determines financial strength and weaknesses of the firm, that is the debtors turnover ratio, the creditors turnover ratio. For example, my dear students, if I calculate debtors turnover ratio talks about, in the numerator, net sales divided by average debtors. So I will know in how many days I am able to collect money for the credit sales I have made. Gross profit ratio, let us suppose gross profit ratio I calculate and I get 20%. It means for every 100 rupees of sales my gross profit is 20 rupees, isn't it? So as I have been telling you all the examples, the financial statements alone does not tell us, it does not give us all the information in order to take decisions. So financial statements put together have to be analyzed so that we give meaning to the financial statements and we can take proper decisions in our day-to-day business life. So analysis of financial statements, my dear students, is an attempt to assess the efficiency and performance of an enterprise. Thus, the analysis and interpretation of financial statements is very essential to measure the efficiency, profitability, financial soundness and future prospects of the business units. Now, my dear students, let us try to understand the meaning of financial statement analysis. The process of critical evaluation of the financial information contained in the financial statements in order to understand and make decisions regarding the operations of a firm is called as financial statement analysis. In simple terms, dear students, it is basically a study of relationship among various facts and figures which are given in a set of financial statements, that is the balance sheet and the profit and loss account, and the interpretation thereof to gain an insight into the profitability and operational efficiency of the firm to assess its financial health and future prospects. So, dear students, the term financial analysis includes two things. One is analysis, second one is interpretation. Analysis and interpretation. The term analysis means simplification of the financial data by methodological classification given in the financial statement. So, you are just simplifying the financial data. Interpretation means explaining the meaning and significance of the data. For example, my dear students, let us suppose we are calculating net profit ratio. Net profit divided by sales into 100. So, net profit ratio comes to 30%. It means for every 100 rupees of sales, the company is earning a profit of 30 rupees. For every 100 rupees of sales, company is earning a profit of 30 rupees. Let us take another example. I have calculated cost of goods sold ratio and it comes to 80%. It means for every 100 rupees of sales, cost of goods sold is 80 rupees. So, 20 rupees is your gross profit. So, as simple as it is. So, the financial data, whatever is there in your balance sheet and profit and loss account, you give them meanings. You explain what it is all about, is what interpretation is. So, these two, that is analysis and interpretation, these two are complementary to each other. Analysis is useless, dear students, without interpretation. You just calculate gross profit ratio 20%. You do not interpret that for every 100 rupees your gross profit is 20 rupees and the remaining 20 rupees, my dear students, should be used to cover the remaining day-to-day expenses which comes in the profit and loss account, after which you will get the net profit. So, analysis is useless, dear students, without interpretation, and interpretation without analysis is difficult or even impossible. So, dear students, financial analysis is the process, in simple terms, of identifying the financial strengths and the weaknesses of the firm by properly establishing relationship between the various items of the balance sheet and the statement of profit and loss. Financial analysis can be undertaken by management of a firm or by parties outside the firm, that is owners, traders, creditors, lenders, investors, labor unions, etc. So, let us discuss the definition of financial statements, my dear students. So, financial statement analysis is a judgmental process which aims to estimate current and past financial positions and the result of the operation of an enterprise with primary objective of determining the best possible estimates and prediction about the future conditions. So, dear students, after understanding what is the meaning and definition of financial statement analysis, let us learn the different objectives of financial statement analysis. The first objective, my dear students, is to measure the profitability. The main object of a business is to earn a satisfactory return on the funds invested. So, we calculate return on investment. So, you have invested 100 rupees, your return is 20 rupees. So, your return on investment is 20%. So, you have to measure the profitability. So, first objective is measuring the profitability. So, the main objective of a business is to earn a satisfactory return on the funds invested in it. Financial analysis helps in ascertaining whether adequate profits are being earned on a capital invested in the business or not. It also helps in knowing the capacity to pay the interest and dividend. The second objective, dear students, is indicating the trend of achievements. Financial statements of the previous year can be compared and the trend regarding various expenses, purchases, sales, gross profit, net profit, etc. can be ascertained. For example, sales in the past 5 years, like in the first year it was 100, second year 200, third year 300, fourth year 400, fifth year 500. So, you can prepare a trend analysis how there is an increase in sales, how there is an increase or decrease in cost of goods sold, how there is an increase or decrease in the different expenses, maybe advertising expenses or salaries or wages, whatever you have paid. So, it indicates the trends of achievements for over a period of time. The third one, dear students, is assessing the growth of potential of the business. That is, the trend and the analysis of the business provide sufficient information for us which indicates the growth potential of the business, whether the business is growing or whether there are losses, it is performing well, it is not performing good. Then the next objective, my dear students, is a comparative position in relation to other firms. So financial statement analysis, when we prepare a comparative statement, it may be a balance sheet or an income statement between two companies, company A and company B. You know the comparative position in relation with other firms as well. So the purpose of the financial statement analysis is to help the management to make a comparative study of the profitability of various firms engaged in similar business. So I am doing fan business, A fan business. So I compare with B fan company limited, C fan company limited. So then I take a decision, or I come to know how my business is performing. Such comparison also helps the management to study the position of their firm in respect of sales, expenses, profitability, etc. The next objective, my dear students, is to assess the overall financial strength. That is, the purpose of financial analysis is to assess the financial strengths of the business. That is, analysis helps in taking decisions whether funds required for the purchase of new machines and equipments are provided from the internal. Like for example, dear students, I as a company have purchased an asset. Asset should always be purchased from the internal sources, that is by raising the equity share capital or by issue of debentures. An asset should not be purchased by the working capital which is there in the company. So how are the assets purchased? Is it from the internal sources of business or not? Did I use the working capital, etc.? All this information can be bought through financial statement analysis. The next objective, dear student, is to assess the solvency of the firm. The different tools of an analysis tells us whether the firm has sufficient funds by preparing the funds flow statement, the cash flow statement, the different ratios. It tells us that whether the firm has sufficient funds to meet its short-term obligation maybe or long-term obligation. Dear students, once we have learned the different objectives of the financial statement analysis, now let us learn the different parties which are interested. The first one is the investors. The shareholders are the proprietors of the business. They are interested in knowing the well-being of the business. They like to know the earning capacity of the business and its prospects of future growth. The management is interested in the financial position and performance of an enterprise as a whole in order to take different decisions, maybe for preparing budgets or for assessing the performance of various departmental activities or heads. The lenders from whom we have borrowed, like the debenture holder, the suppliers, or from people who have taken a loan, they want to know the short-term liquidity of the position, whether the company will repay or not. The suppliers and trade creditors, they are interested to know about the solvency of the business, that is the ability of the company to meet the debts as and when they fall due. The tax authorities are interested in knowing the financial statements for determining the tax liability. Researchers, like students like you, in order to prepare projects or different financial statements, can be used to do research work. Trade unions and employees working in the organization, they are interested to know the growth of profits, as a result of which they can demand better remuneration and different working conditions to improve the infrastructural facilities in the organization. Government and other agencies, they need financial information to regulate the activities of the enterprise industries and determine taxation policies. Also stock exchanges, the stock exchange members take interest in financial statements for the purpose of analysis because they provide useful financial information about the company, whether to invest in stock of a particular company or not. Then let us discuss the different tools or methods of financial analysis, dear students. These are the different tools which the company uses. One, the comparative statement, where you prepare a comparative balance sheet and a comparative profit and loss account. A common size statement, where you prepare a common size income statement and a common size position statement. Trend analysis, different items in the balance sheet and profit and loss account. You prepare trend analysis for over a period of time, for 5 years, 10 years, 15 years, whatever is the requirement of the company. Different types of ratios are calculated for different purposes and decisions. The funds flow statement and the cash flow statement. To repeat, dear student, the different tools are comparative statement, common size statement, trend analysis, ratio analysis, funds flow statement and the cash flow statement. So let us discuss the comparative statements, dear students. These are the statements showing the profitability and financial position of a firm for different periods of time in a comparative form to give an idea about the position of two or more periods. It usually applies to the two important financial statements. As I have told you, you prepare a comparative position statement, that is a balance sheet, and a comparative income statement, that is the profit and loss account, for two or more periods. The financial data will be comparative only when same accounting policy. So whenever you are preparing a comparative statement for two different periods of the same company or two different periods of two different companies, same accounting policies, same accounting principles, same accounting conventions and postulates have to be used. Otherwise, we cannot prepare a comparative statement. So comparative figures indicates the trend and the direction of financial position and the operating results. This analysis is also known as horizontal analysis. So comparative statements gives you a horizontal analysis. Then comes the common size statements, dear students. These are the statements which indicate the relationship of different items of a financial statement with a common item by expressing each item as a percentage of the common item. That is, my dear students, whenever you are preparing a comparative position statement, total asset is taken as 100 and the remaining items are converted based on total asset, which is 100. Total liability is taken as 100 and the remaining items in the balance sheet is converted based on the total liabilities 100. And when you are preparing a common size income statement, total sales is taken as 100 and based on total sales as 100, the remaining items are converted as per the total sales, the base total sales being 100. So such statements also allows an analyst to compare the operating and financing characteristics of two companies of different sizes in the same industry. So you can prepare a common size balance sheet or you can prepare a common size income statement for the same company for two different periods, or you can compare between two different companies, A company and B company. So thus common size statements are useful both in interfirm comparisons over different years. So I can prepare a common size statement for 2 or 3 years to compare how did my company progress for 2 or 3 years, interfirm comparison, or I can compare 2 or 3 companies, A company, B company, a C company, 2 or 3 companies, and I can compare how I am performing in comparison to the other companies or my competitors in simple terms. So this analysis is also known as vertical analysis. Comparative analysis or comparative statements was a horizontal analysis, whereas a common size statement is a vertical analysis. Then the trend analysis, dear students, it is a technique of studying the operational results and financial position over a series of years. It may be 2 years, 3 years, 4 years, 5 years, 10 years, 15 years. So using the previous year's data of a business enterprise, trend analysis can be done to observe the percentage changes over a selected period of time. The trend percentage is a percentage relationship in which each item of different year bear to the same item in the base year. That is 1 year. The first year can be taken as a base year 100 or the last year can be taken as a base year 100. Based on that, the remaining data are converted based on which decisions are taken in trend analysis. So trend analysis is important because with its long run view, it may point to basic changes in the nature of the business. By looking at a trend in a particular ratio, one may find whether the ratio is falling, rising or remaining relatively constant. From this observation, a problem is detected or the sign of good or poor management also is detected. Then comes ratio analysis, dear students. A ratio is a mathematical number calculated as a reference to relationship of two or more numbers and can be expressed as a fraction or proportion or percentage and a number of times, like it can be 2/3 or 1:2 or 20% or 5 times, like turnover ratios are calculated in times. 5 times, 6 times, 7 times. So when the number is calculated by referring to two accounting numbers derived from the financial statements, it is termed as accounting ratios. In simple terms, dear students, when the number is calculated by referring to two accounting numbers derived from the financial statement, it is termed as accounting ratio. For example, if the gross profit of the business is 10,000 and the sales is 1 lakh rupees, gross profit ratio will be 10%, that is 10,000 divided by 1 lakh, that is for every 100 rupees of sales your gross profit is 10%. Similarly, let us suppose you calculate inventory turnover ratio and you get the answer as 6 times. It means inventory is converted into sales 6 times in a year. Isn't it? Whenever raw material is converted into work in progress is converted into stock or inventory. This stock, only when it is sold, revenue is generated for the company. The more the inventory turnover ratio, the better it is. So if you get the answer inventory turnover ratio 6, it means in a year, in a financial year, in 12 months, the inventory is converted into sales 6 times in a year. It needs to be observed that accounting ratios exhibit relationship, if any, between accounting numbers extracted from financial statements. That is, ratios are essentially derived numbers and the efficiency depends a great deal upon the basic number from which you are calculated. That is, if the financial statement contains some error, the different ratios whatever you calculate also will have errors. So you should keep in mind, my dear students, the financial statement, the profit and loss account and the balance sheet, the base for which you are preparing the financial statement analysis should be appropriate and correct. And also, my dear students, you should also keep in mind a ratio must be calculating using numbers which are meaningfully correlated. For example, a ratio calculated by using two unrelated numbers would hardly serve any purpose. For example, the furniture of a business is rupees 1 lakh and purchases are 3 lakh. You calculate purchases to furniture ratio, 3 lakh divided by 1 lakh, you get 3. But what is the purpose of calculating purchases to furniture ratio? 3 lakh divided by 1 lakh, 3. There is no purpose. There is no use. So, two unrelated numbers, you cannot calculate ratios. Ratios has to be calculated where there is some meaning, like the gross profit ratio. Gross profit is 10,000, sales is 1 lakh, gross profit ratio is 10%. So, for every 100 rupees of sales, your gross profit is 10. So, these are the different types of ratios: liquidity ratios, solvency ratios, profitability ratios, turnover ratios, market value ratios. These are the different ratios what you calculate. Then comes the fund flow statement. A fund flow statement is a statement prepared to analyze the reasons for changes in the financial position of a company between two balance sheets. It portrays the inflows and outflows of funds, that is the sources of funds and application of funds for a particular period. Fund flow statement is one of the tools for analyzing the financial position of a firm. It is a statement showing how funds are obtained and utilized for various business activities in a specified period, and that is the reason why it is called as a funds flow statement. The cash flow statement, it refers to the analysis of actual movement of cash into and out of the organization. The flow of cash into the business is called as cash inflows, and positive cash inflows and the flow of cash out of the firm is called as cash outflows or negative cash flows. The difference between the inflow and the outflow is called as net cash flow, and a cash flow statement is prepared, my dear students, to project the manner in which the cash has been received. Fund flow statement tells us the movement in the working capital. Cash flow statement tells us the movement in the cash, one item in the working capital. Thus, the cash flow statement summarizes the causes for the change in cash position of a business enterprise between dates of two balance sheet. So, we prepare a comparative balance sheet, my dear students. We have two columns for 2 years. The third column is used to show the changes, that is increase and decrease figure. The fourth column may be added for giving percentages of increase and decrease. We prepare the comparative income statement, the common size income statements, whatever we have discussed. We prepare trend analysis. 1 year is taken as a base year. Generally, the first or the last year is taken as a base year. And my dear students, to conclude, financial statement analysis helps both the companies and the investors determine the health of a business. These reports can help them decide if they should invest or change their strategies. It allows businesses to see if they are improving on anything. If the company is losing money, it can try to see whether it is making its mistake or improves that area. Conversely, if the company is doing well, it can prepare for future growth. That is, you focus on your mistakes, see that you do not repeat. You focus on your strengths so that you work on your strengths to improve further. So financial statement analysis is like checking a company's report card. Like we get report cards, financial statement analysis are report cards of companies. It indicates how good the business is at managing its money. The information keeps businesses on track to success. The analysis of financial statement helps the individual make better financial decisions. At the end of it, all financial statement analysis is important to ensure that businesses remain healthy and grow. Thank you, my dear students, for your patient listening.